Have you ever wondered where trillions of dollars vanish without a trace? Imagine a maze of hidden channels where more than $60 trillion flow, untouched by any central bank or regulator. Picture a dimly lit trading floor deep beneath the streets of London, monitors aglow with anonymous transactions, while suits in shadowy corners whisper about overnight fortunes and silent collapses. In this murky underworld, ordinary rules don't apply, and fortunes are made or lost before the sun even rises. Close your eyes and see a glowing ticker tape snaking across a giant curved screen, each flicker revealing another offshore vehicle or shell company funneling wealth through secret conduits. Feel the tension as your pulse quickens with every surge in the ledger, a ripple that can redraw balance sheets halfway around the world in the blink of an eye. This isn't science fiction, it's the daily life of the shadow banking system, where regulatory blind spots and complex derivatives create a playground for the bold and the reckless. Let me take you on a journey into this hidden labyrinth of capital. We'll uncover how hedge funds stretch credit lines through exotic instruments, how money market funds masquerade as cash, and why a single whisper in a dim corridor can trigger a cascade of global credit events. By the time we're done, you'll see why watching the shadows may be more important than watching the headlines. Because the real game is played off the books, and it's shaping every market you care about. Long before the term shadow banking entered our lexicon, a parallel financial universe was quietly taking shape. In the aftermath of the post-war boom, governments built safety nets to shore up commercial banks, but innovators on the fringes began experimenting with credit and liquidity outside those guarded walls. Picture an animated timeline unfurling across your screen. In the 1970s, money market mutual funds raised their first trillion. By the 1980s, securitization slices mortgages into tradable slices. And by the turn of the millennium, complex collateralized debt obligations spin off risk in ever more exotic configurations. Behind this evolution lies a simple incentive: yield. When traditional deposits barely keep pace with inflation, institutions chase higher returns through vehicles that operate like banks, taking deposits, extending credit, and leveraging collateral, yet escape the tight oversight applied to commercial lenders. Imagine layers of faintly glowing ledger lines sliding across a globe, each thread connecting hedge funds, investment banks, insurance giants, and offshore conduits in a web more intricate than any spider's. By 2007, the notional value of shadow banking instruments eclipsed $40 trillion. As credit default swaps flicker to life on a giant curved wall of screens, you sense the dizzying scale of bets placed on the unseen. Repurchase agreements, short-term loans secured by government bonds, morph into a vast overnight market where trillions change hands each evening. Special purpose vehicles quietly accumulate wholesale funding, then vanish from balance sheets as regulators peer elsewhere. Yet this ingenious financial ecosystem comes at a cost. When the subprime crisis erupted in 2008, these off-balance sheet structures acted like hidden fault lines. Charts spike and plummet in rapid succession, showing markets freezing overnight as liquidity evaporates faster than regulators can react. Governments scramble to rebuild confidence, injecting public funds to plug the gaps. An ironic twist for instruments designed expressly to avoid public scrutiny. Today, this underworld has grown even more elaborate. New technologies enable peer-to-peer lending platforms, algorithmic hedge funds, and tokenized asset pools that blur the line between regulated banks and unregulated intermediaries. A 3D map emerges, nodes glowing in jurisdictions from the Cayman Islands to Singapore, each representing trillions parked beyond the reach of conventional oversight. Understanding how we arrived here is essential to navigating the modern financial maze. In the next segment, we'll peel back each layer, demystifying conduits, shadow vaults, and credit waterfalls, to reveal why trillions still course through uncharted back channels. Watch the data animations shift from grays to vivid color as the hidden market comes into focus. At its heart, the shadow banking system is a network of financial intermediaries camouflaged beneath layers of complexity. Imagine a cascade of animated arrows flowing from a hedge fund into a special purpose vehicle, where mortgages and corporate loans are pooled, sliced into tranches, and sold off to investors hungry for yield. As each tranche shifts hands, a translucent ticker scrolls overhead, revealing how risk and return are redistributed in real time. This process of securitization transforms illiquid assets into tradable securities, allowing institutions to offload credit exposure while still earning fees on origination and servicing. Meanwhile, repurchase agreements act like high-speed conveyor belts. One party sells a bond with the promise to buy it back the next day, effectively borrowing cash at overnight rates. Picture millions of these tiny transactions tickering across a globe-spanning digital map, each line pulsing with the promise of leverage and liquidity. Liquidity transformation doesn't end there. Money market funds step in as shadow banks' own retail arm, offering investors the comfort of apparent cash-like instruments while reinvesting in short-term commercial paper in Treasury repo. See an investor's smartphone screen, the balance glowing reassuringly $100,000, even as that cash is silently redeployed into collateralized loans behind the scenes. As credit conditions tighten, these funds can break the buck, triggering panicked redemptions that reverberate through the system. Hedge funds, too, borrow heavily on margin, using total return swaps that let them gain exposure to equity and debt without holding the underlying assets. Visualize a 3D bar chart soaring as leverage ratios spike, then teetering precariously when margin calls rip through the market like a shockwave. This dark labyrinth of credit creation and transfer comes at the cost of opacity. Regulators rely on balance sheet disclosures to gauge systemic risk, but shadow entities slip off those ledgers entirely. Special purpose vehicles vanish like specters when their backers deem them inconvenient, leaving regulators chasing phantom exposures. Now imagine a courtroom scene where investigators sift through shredded documents and offshore registry entries, trying to trace the ultimate owners of complex derivatives and conduit loans. The resulting blind spots mean that stress in one corner of the market can cascade unpredictably. Just as a collapsed repo market froze credit in September 2019, when demand for cash suddenly outstripped supply and surged overnight funding rates to 10%. Yet for those who navigate the maze skillfully, the rewards can be staggering. Large banks syndicate loans into collateralized loan obligations that yield hazard-like spreads in exchange for subordination risk, while shadow firms offer bespoke credit solutions to corporate clients shut out of traditional lending channels. Picture a corporate treasurer in a sleek high-rise conference room, hammering out a tailor-made funding package that blends asset-backed commercial paper, private placements, and synthetic credit. Behind him, digital dashboards update in real time, showing the blended cost of capital inching down as each leg of the structure is sold to eager investors. To quantify the scale, consider these figures. At its peak in 2019, the global shadow banking sector held roughly $52 trillion in assets, equivalent to the entire US GDP. An animated globe rotates slowly, pinpointing major hubs in New York, London, Hong Kong, and offshore financial centers. Conduits in Luxembourg channel cash from pension funds, collateralized debt obligations in Dublin, spice risk for yield, and structured investment vehicles in the Cayman Islands evade straightforward regulation. Such dispersion magnifies the challenge of coordinated oversight, because each jurisdiction applies different rules to entities that, in practice, operate as banks. This intricate web of credit flows can amplify shocks, as demonstrated by the 2007 to 2008 financial crisis. A sudden drop in housing prices triggered delinquencies in mortgage-backed securities, splintering confidence in related derivatives. Animated dominoes fall in slow motion across the screen, each labeled ABC, XYZ, and 1, 2, 3, representing different securitization layers that topple in sequence. Panic spreads from subprime conduits to money market funds, then to repo markets, until central banks must inject trillions in emergency liquidity, raising the ultimate question of moral hazard and taxpayer backstops. Understanding these mechanisms is crucial for any investor, policymaker, or citizen watching the modern financial system. In the next section, we'll step into the shoes of those who have weathered the storm, real-world stories that illustrate both the ingenuity and the peril of shadow banking's hidden corridors. Consider the summer of 2007, when a mid-sized finance firm in London quietly plowed billions into collateralized loan obligations tied to subprime mortgages. Picture an opulent executive suite overlooking the Thames, where a team of analysts high-fived as tranche after tranche sold out to eager offshore investors. On their screens, a dashboard lit up in green while coffee cups steamed in the morning light. They believed they'd engineered the perfect risk-return sweet spot until delinquencies ticked higher and that steady green glow flipped to red. Within days, margin calls crushed their leverage, forcing fire sales of assets that rippled through money market funds and triggered a scramble for liquidity across Europe. In that one boardroom, the glamour of shadow banking collided head-on with its Achilles heel, opacity. Now shift to Asia, 2014. A Hong Kong hedge fund, famed for its secretive trading strategies, uncovered an anomaly: growing haircuts on repo transactions with Japanese banks. Imagine traders in sleek glass towers watching rates drift from 0.1% to 1% overnight, their calm confidence giving way to tense phone calls. They realized that collateral they'd relied upon, Japanese government bonds, was suddenly treated as less liquid, a silent signal of stress nobody had anticipated. The fund raced to unwind complex securities built on those bonds, but the web of synthetic derivatives meant every unwind echoed through credit default swaps and prime brokerage lines. By the time auditors pieced it together, the fund's assets under management had shrunk by nearly 40%, and counterparties around the globe were left tallying hidden exposures. Fast forward to 2019, when a U.S. money market fund broke the buck after heavy redemptions rattled confidence in its prime commercial paper holdings. Envision investors on mobile apps frantically clicking "redeem," while a ticker at the bottom of the screen flashed alarming rates. News feeds exploded with headlines about the first break since 2008. Behind the scenes, fund managers scrambled to liquidate short-dated paper, only to discover that liquidity wasn't as abundant as promised. This single event throttled lending to small businesses reliant on commercial paper markets, illustrating how a localized panic in one corner of the shadow system can throttle real-world credit for Main Street companies. Each case shares a common thread: innovation without transparency. In London, the firm underestimated how fast mortgage defaults could cascade. In Hong Kong, no one foresaw repo haircuts on sovereign debt. In the US, investors lost faith in the promise of cash-like instruments. Yet these failures also sparked reform. Regulators introduced swing pricing mechanisms for money funds, required greater disclosure for complex securitizations, and pressured banks to tighten repo collateral standards. Visualized policymakers huddled around screens, overlaying new regulatory text on top of old balance sheets, determined to seal the cracks exposed by each crisis. These examples underscore a vital lesson. Shadow banking's ingenuity can power tremendous growth, but when the lights go down, hidden corridors can become perilous labyrinths. By dissecting real-world failures, we learn not only the mechanics of what went wrong, but also how targeted oversight and improved transparency turn potential disasters into catalysts for a safer, more resilient financial ecosystem. To navigate the shadow banking maze, start by treating every investment like a detective case. Picture a split screen. On one side, you scanning balance sheets for off-balance sheet vehicles. On the other side, animated check marks appearing next to transparent disclosures. Prioritize instruments with clear collateral. See a semi-transparent vault door closing behind concrete assets, over opaque structures that vanish when you dig deeper. Next, diversify your credit exposure. Imagine a wheel chart spinning to reveal slices labeled money market funds, asset-backed commercial paper, and corporate bonds. Each slice pulses to indicate relative risk. By allocating across multiple vehicles, you reduce the chance that a single domino fall triggers your entire portfolio's collapse. When new products emerge, like tokenized loans or peer-to-peer pools, visualize a radar sweep highlighting them on a digital map, then perform a mini due diligence audit before committing capital. Leverage stress testing tools daily. See an interactive dashboard with sliders for collateral haircuts and liquidity squeeze. As you drag the haircut slider higher, warning lights blink on risky exposures. If your projections show funding gaps under a 10% shock, adjust your allocations until the warnings disappear. You can even set up automated alerts that flash when repo rates spike or margin requirements tighten. An overhead ticker that turns red when thresholds are breached. Maintain strong counterparty relationships. Picture yourself in a virtual conference room with key fund managers and prime brokers. Each handshake icon you click strengthens credit lines. Regularly review their credit ratings and liquidity pools. Watching gauges move in real time. If a partner's liquidity ratio dips below a safe level, see a flag appear beside their name, prompting you to reallocate exposure before it's too late. Finally, stay informed on evolving regulations and market conventions. Envision a globe where regulatory updates from major jurisdictions light up as notifications. Click on each glowing node to view concise summaries. Integrate these updates into your investment workflow so that any swing pricing rule or new disclosure mandate automatically populates your compliance checklist, complete with green check marks as you satisfy each requirement. By combining rigorous due diligence, dynamic stress testing, and proactive relationship management, you can harness the ingenuity of shadow banking while avoiding its hidden pitfalls. Let these strategies guide you through the labyrinth, turning opaque corridors into illuminated pathways of opportunity. As we step back from the hidden corridors of shadow banking and into the light of everyday finance, remember this: every complex conduit, every overnight repo, and every off-balance sheet vehicle ultimately traces back to real-world impact on portfolios, on policy, and on Main Street. You've seen how trillions of dollars sneak through unregulated channels, how crises ignite when opacity meets leverage, and how smarter rules and sharper diligence can turn a perilous labyrinth into a path of opportunity. Picture the final frame shifting to your screen. Our channel logo emerges center stage against a backdrop of animated rule books and candlestick charts. A subscribe button pulses in the bottom right, inviting you to join our community of market explorers. On the left, a floating comment box blinks. Tell us your biggest takeaway, while subtle confetti trails celebrate each new subscriber. If this deep dive illuminated risks you didn't know existed or revealed opportunities you want to explore, smash that like button. Subscribe for more incisive stories that bring the unseen gears of finance into view. Hit the bell to get notified the moment our next episode drops, tackling topics like crypto's shadow realms or the next wave of regulatory reform. And now it's your turn. Drop a comment below and let us know which shadow banking twist surprised you most. Share this video with a friend who needs a backstage pass to the financial underworld. Together, we'll keep peeling back the layers, because when it comes to money's secret underbelly, curiosity is your greatest asset.